Okay, in this video, we begin the process of learning journal entries and bookkeeping. Let me start off by asking you, what is this? What is that? That's your left hand. No, it's not my left hand. This is my debit hand. And this is my credit hand. It's not my right hand. It's my credit hand. So there's a big problem that students have when they come into accounting. People come in having heard and even used the words debit and credit in the past, and they think they know what they mean, and they have no clue. And some of you are like, oh, no, wait a second. I got one of these cards here. I got a car. I got one of these cards. It's a debit card, and I got a credit card. I know what a debit and credit is. I use those cards all the time. I've used them for decades. Hey, guess what? That has nothing to do with it. Debit means left. Credit means right. And that's all. Accountants have come up with our own names for what left and right is. Debit means left and credit means right. And some of you watching this are thinking, oh no, Kyle's just exaggerating. You know, Professor Welch, I mean, he's just over the top on this stuff. He is not being, he's just being over the top. There's more to it than that. He's maybe dumbing it down. I'm not dumbing it down. Please. Matter of fact, I only do this a couple times. I'm going to get down on my knees and beg you. Please. Give up on any idea that debit and credit is anything more than meaning left and right. Just get rid of it. Just don't think about it. Debit means left and credit means right. That's what it means. That's what these things mean. Debit means left and credit means right. I have students that I explain this to. I've begged them and they won't give it up. They won't give up. Whatever hard drive that is in your brain, bleach it. Bleach that hard drive, kill that hard drive, delete it, wipe it clean, and just understand that debit means left and credit means right. And that's it. And debit and credits, it's for organizing. It's an organizing thing we do for accounting, and debit truly means left, credit means right. We can't go on until you're there. So if you're not there yet mentally, please just rewatch the last couple minutes because you need to get there. Debit means left, and there's no deeper meaning. Credit means right, and there's no deeper meaning. Left and right. And the reason why we have left and right is because we do these things. We have these things called T accounts. They're essentially a summary of what a journal entry might be. We have things on the left and the right of these T accounts, and they mean different things at different times. So for example, something that is on the left of your assets in the equation will increase your assets. But guess what? Something that is on the left of liabilities will decrease it. It'll go down in the opposite direction. So you can see how thinking about debits and credits as anything other than left and right will be a problem, because a debit sometimes is an increase and sometimes is a decrease. And a credit, something on the right, is sometimes a decrease and then sometimes an increase. And the difference is that everything on the left side of the equation with assets is an increase with a debit, and everything on the right side of the equation is an increase with credits. And the opposite is true with debits. And so you have to think of things as debits and credits as being left and right and where you are in the financial statement. And if you don't think about it that way, you're going to have a problem. So you need to get there. That's what this session is going to be about. Now, for journal entries, you don't need to draw a T, but you still need to know all the accounts are affected. Debits in journal entries are usually listed first, and the account names and then the dollar amounts. I'll show you an example in the next few slides. Credits are listed second, and they're indented to the right. That's how you know they're a credit. If you want to make extra sure, you can put a D or a C right next to it in brackets to let me know that you know it's a debit or credit. And the sum of all the debits in the accounts needs to equal all the credits. What does that mean? The sum of everything that is written a little bit to the left needs to equal everything that is written a little bit to the right. Assets equals liabilities and owner's equity, and the accounting equation must remain in balance. Like we said before, the left side of the equation where the assets are, debit will increase it. On the right side, debits decrease it, and credits decrease on the left side of the equation, and on the right side of the equation, they increase it. So That's just important to understand and get your mind around. It's going to take a couple times looking at this to really sink in and really understand where your bearings are with where debits and credits are and increases and decreases. So just one more time, left side of the equation, left of the equal sign, assets. So all the accounts that are under assets, they increase with debits and they decrease with credits. They increase when you have something on the left side of this T account, and they decrease when you have something on the right. Liabilities, if you write a journal entry for liabilities, it's the opposite because it's on the opposite side of the equation. Everything on the opposite side of the equation for liabilities, they decrease with debits and they increase with credits, increase with the things that are written a little bit indented to the right. Owner's equity or shareholder's equity decreases and increases, and same, and because income and expenses and revenue and retained earnings are sub-accounts basically of owner's equity and shareholder's equity, it's the same, decreases and increases. So decreases are debits on the left and increases are credits on the right. And I usually, when I do my examples in the journal entries, I have like 26 videos on journal entries that are like 4 minutes long, 3 minutes long each one, where I go through just different examples and problems. I use this as a setup for the equation. You see there's assets here and then the equals liabilities plus owner's equity. And I have debits going up here and credits showing an arrow going down, showing what's happening to your assets. If you have a debit, you're increasing your assets. And if you have a credit, you're decreasing your assets. And then I made a checkered kind of arrow over here on the other side of the equation because the opposite's true on the other side. Debits decrease your liabilities and credits increase your liabilities. Same with owner's equity. If you have an expense in your income statement that flows through to owner's equity, a debit it's going to be a debit and a credit is going to be an increase. So like revenue would be an increase, and that's a sub-account of retained earnings, which flows to owner's equity. This is another idea that I got one of my favorite professors, Clayton Christensen. You kind of can bucket two different worldviews of God. And I know a lot of you are like, God, am I in a theology class right now? No, you're in an accounting class. Okay. So, but there's kind of two worldviews of God right now. There's this one view where there's kind of a Zeus kind of view of God, where God just creates lightning bolts and just makes things happen. And then there's this other view, and espoused by, Albert Einstein's a great view of it. And God is a scientist, not a magician. And this is the idea that God is somebody that actually works within laws and rules and is bound by those rules and laws as opposed to being outside of it. In this class, when we talk about journal entries, I frequently say, don't be a Zeus accountant. Zeus accounting is not allowed. What I mean by that is that you can't break the laws of accounting. There's certain rules and principles of accounting, and they come in handy with journal entries. And so when I say don't be a Zeus accountant, what I'm saying is don't be outside of the laws that you have to deal with accounting when you write your journal entries. The laws of accounting will let you find out, it will teach you where the right journal entry is. And so let's talk about those things. So first of all is remembering everything goes back to the balance sheet. It's kind of like in Finding Nemo, where all drains lead to the ocean. Everything goes back to the balance sheet. I don't think all drains lead to the ocean, but everything goes back to the balance sheet on this. And that's helpful to remember when you're thinking about the income statement. The income statement flows back through the balance sheet. People get really mixed up with revenues and expenses in the journal entries. But if you think of them as just sub-accounts of shareholders' equity, you're able to kind of make the connection and realize, okay, debit, credit, and where things go. And so the income statement flows back through to that balance sheet. And a lot of times people have a hard time seeing how revenue and expenses are sub-accounts of that shareholders' equity. So what I do in my examples is I typically have an income statement here, and then I have this arrow showing, oh yeah, this is a sub part of owner's equity, and retained earnings is how it gets over there. So remember, everything flows back to the balance sheet. Okay, second one, the accounting equation must remain in balance. That means assets equals liabilities plus owner's equity, all right? So if you increase something on one side of the equal sign, you have to increase something else on the other side of the equal sign. If you decrease something on one side of the equal sign, you have to decrease something on the other side of the equal sign if there's nothing else to do. So for example, if you sell inventory, you sold your inventory, so your assets are going to go down. Inventory's leaving. And so on your owner's equity, underneath that where you have expense, you need half cost of goods sold goes down. Inventory's going down because you sold some inventory, and owner's equity is going down because you have an expense of getting rid of your inventory to make a sale. All right. So you would represent that inventory going out and some sort of cost of goods sold on that. And it's also true to remember that you could have purchased something to be inventory. In that case, you have a decrease in one asset account and an increase in another. And that would still make the accounting equation unequal because the assets are going down and up at the same time by the same amount. So the accounting equation is imbalanced. So the rule is the accounting equation has to remain in balance. So that's an important rule of the accounting universe. Debit means left and credit means right. And I can't tell you how important it is to just accept that. Just accept that. Just embrace it. There's no political divide on this. This is like one of these things that everybody just says, yes, that's what it is. And that's what it means. Debit means left, credit means right, period. There's not a deeper meaning. That's what it is. And the reason why it's important not to think of it as increases and decreases and just left and right is because if you think about debit as being an increase or a credit as being an increase, like you might think about with, oh man, it hurts your ears to hear this, but like a credit to your account with a credit card company. Ugh. All right. When you hear these type of things, you might think, oh, I know what they are because I've dealt with a lot of stuff and I've gotten returns and gotten credits to my account. But the reality is that if I showed you on this chart, debits can sometimes be an increase and sometimes can be a decrease, and same with credits. And so don't think of them as increase and decrease. Change that. You got to reformat your hard drive. Take that thing out of your brain that thinks that and just drop kick that and get that out of here. There's other rules. Every transaction has at least one debit and one credit. You have to have one debit and you have to have at least one credit, at least one of both. Now you're not limited. You could have one debit and two credits. You could have one credit and two debits. You could have multiple debits and one credit. You just have to have at least one of each. Every transaction has to impact at least two accounts. All right. So if you were in our inventory purchase example, if you're buying inventory with cash, your cash account would go down and your inventory account would go up. This is an important one. The sum of all your debits has to equal the sum of all your credits. That's another rule. And if you know that rule, you can figure out a lot with figuring out journal entries. So the sum of all your debits has to equal the sum of all your credits. That means everything that you debit, if you totaled all the debits up and then totaled all the credits up, they have to equal the same amount. They have to be balanced with each other. And that's just within the journal entries. And the final thing to remember, Zeus accounting is not allowed. You have to follow these rules. You have to follow these rules, and you live in a universe of accounting, and these are the rules. And I want you to be Jedis when it comes to understanding this stuff. So no Zeus accounting in this class. You have to follow these rules, and anytime you deviate from these things, you're going to get something wrong. All right, there's a few steps. First, identify all the accounts involved. And I always say it's always easiest to start with things that are tangible first. Think about things you can touch. You can touch cash, you can touch card, equipment. It's easier to think about those things because you know there's some sort of asset. And if you're getting it, it's going to be a debit. And if if it's going out of your business, it's a credit. When it comes to the asset account, it's going to be something written on the left or the right, and it's easier to understand what that is and start with assets in that way. Determine if the account is increasing or decreasing. That means debit or credit, depending on where you are, and determine how much it changed. And once you do that, if you look at all the other rules, you can kind of back into these journal entries and figure things out. So this is a sample of what a journal entry might look like. This is a very simple what you do. You have a debit here, which is kind of described with the D, and then a credit. And then you have the account name and an amount, and then the credit would be a different account and the same amount, so that your debits and credits would be in balance and equal. So that's the intro to journal entries. In the other video, we're going to have some examples, a lot more examples of how to do journal entries